price can be defined within the context of trading as the point that a financial security is bought or sold at any given time. Ultimately, the marketplace, through supply and demand, determines a financial security's price. However, price movement is a broad subject, and there are a number of external factors that can impact on its movements. The study of any factor that has an impact on the price of a security, whether it is financial, economic, or political, is known as fundamental analysis and is commonly referred to as fundamental or macroeconomic factors. Regular economic data releases are one of the major influencers of price changes. Some of the key economic data releases include non-farm payroll, gross domestic product, interest rates, and consumer price index. These indicators have scheduled data releases and should be locked into every trader's calendar. The dates of the releases can be found online at the ADSS Economic Calendar. Price of a financial security will generally be at its most volatile if a key indicator release includes unexpected results. We will now look more closely at some of the fundamental indicators that can impact price. The non-farm payrolls, or NFP, is a key economic indicator. Although released from the US, it permeates globally as it measures the entire US employment figures, with the exclusion of farm, government, non-profit, and private household employees. The NFP figures are announced monthly, and this is probably the most eagerly awaited economic indicator to be received by the foreign exchange or Forex community, due to the wide-ranging nature of the numbers. If employment figures are lower than expected, then this is likely to have a negative impact on price, as there are less jobs and money, and therefore reduced spending. The reverse may be factored in as an expectation if the figures come in higher than anticipated by the markets. A country's GDP measures the gross value of all the domestic products and services produced within 1 year. GDP measures the well-being of a nation's economic status. Any growth or decline in the GDP will invariably have a correlated impact on the markets. If the GDP is higher than the previous year, this will usually have a positive impact. By contrast, if there is a decline, then it is usually expected that prices will fall. The CPI gauges the price of products and services within a country and is widely used to measure inflation. It is the most widely used measure of inflation and is a proxy for the effectiveness of the government's economic policy. As with the interest rates, the CPI can affect both company profits and consumer spending. In theory, higher inflation rates will generally have a negative effect on a currency value and will reduce consumer spending. As a rule of thumb, as interest rates change, the value of a currency will either rise or fall, and consumers and businesses will either spend more or less. In turn, this can result in public companies releasing higher or lower profit announcements, with the markets responding accordingly. Central banks, such as the US Federal Reserve, have played an increasingly large role in using changes to the target rates at which they supply money to commercial banks to influence economic policymaking. They have frequently acted to either reduce or increase the country's money supply in order to stabilize their economies and manage inflation. Changes in central bank rates are a key influencer on overall price movements in the economy. To sum up, the market does not like surprises. Traders need to be always aware of planned data releases and to keep abreast of unexpected political or economic bombshells.